So let's talk about Rivian for a moment, because lots of stuff have happened with Rivian since the last podcast. So since the last podcast, they came out that that they basically exceeded their delivery, both production and delivery guidelines that they had given by pretty significant amount. Actually, do you have those numbers? Yeah, there we go. So they produced 12,600 vehicles, delivered 12,100. And then they raised their guidance. By the way, the estimates were that they were going to deliver somewhere between 9 and 11,000, and they delivered 12,194 vehicles. So pretty substantial beat on deliveries. And then they raised their delivery guidance for the entire 2026 to 65,000 to 70,000 vehicles, up from, I believe, 60 to 65,000 vehicles before. So they increased it by roughly 5,000 vehicles. So really, really good news there. That happened on July 2nd. And then their stock price has been sort of like on this upward trend. And when was it? Monday that they announced, on Monday, their stock price broke $20 a share. And after the close, which it closed over $20 a share, they announced that they are raising or selling 75 million shares on the open market. Or not the open market. They're selling 75 million shares in a placement to raise more funds. They also announced their quarter estimate of revenue is between 1.55 billion and 1.65 billion. So the estimates prior were 1.44 billion. So they're going to have at least 100 to 200 million dollars more revenue than they were expecting. Or the analysts were expecting. So there's a comfortable beat on revenue of between 7 and 15%. Fantastic beat, fantastic raise in sort of like guidance on deliveries. The guidance on deliveries estimate, by the way, going to up to 70,000 vehicles means that in the second half of 2026, they're going to deliver 100% more vehicles than the second half of 2025. So that's a very, very substantial increase in deliveries, which is going to result in a very, very substantial increase in revenue. It's not going to be quite 100% more in revenue because the R2 is a lower priced vehicle, but it is going to be pretty substantial, at least 50, 60% more revenue in the second half of 2026 than 25. So all of this good news has happened. The Monday news was, in my view, extremely welcome. The reason they did that additional 1 point whatever billion raise, which we now know it was priced at a price point that ended up raising 1.2 billion for them. The reason they did that 1.2 billion raise is so that they can accelerate their Georgia plant and start using the loans, the Department of Energy loans. They get access to $4.5 billion there to build the plants to expand their manufacturing capacity. So all of this is like fantastic news from like the company, the progress, the R2 sort of production ramp. All of that is just phenomenal. You couldn't ask for better execution and growth for a company than what Rivian is doing. Now, since Monday, the stock has tanked from the $20 closing point to where it was around 15 and changed earlier today. I think it closed the day, at $16? We can't see it on that graph there. 65. So, it's down substantially from the $20 mark, but with lots of good news added. And, sometimes the market does that, where good news means that the stock gets sold off. And some Rivian investors, surprisingly, are extremely upset about the news, about the raise, about the fact that they're going to get diluted, 6 to 7.5%. And my view is that dilution is part of the game when you're in a stock that is in a company that is not profitable. What would you expect them to do? Like shut down and declare bankruptcy? Because that's the only other option. When you're losing money and you're eventually going to run out, you either have to raise money and dilute existing investors, or you have to shut down and declare bankruptcy. Those are your only two options. You can also, take out loans, I guess. But But in Rivian's case, they're also doing that. So they're combining raising money from capital that is not loans. This is the $1.2 billion is not a loan, but they're also taking out loans from the Department of Energy, for example, to build their next manufacturing facility, and they have $5.2 billion in cash as well. So they're very well funded now for at least the next year, and the next year should be so positive for them that the valuation should go up. There should be an opportunity to raise more money, which means more dilution will come, by the way. If you're a Rivian investor, you should know that up front. Don't invest if you don't think it's going to get diluted any further. But hopefully at much higher valuations, which will mean lower dilution percentages. So, I've seen this play out every time for, every company that is not yet profitable raises. Tesla had to do that multiple times, several times during the time that I owned it between 2015 and 2019 or 2020 when it became profitable. Rocket Lab has had to do that several times. And every time these companies get hit too, like when they announce that they're raising or there's going to be some dilution coming, their stock price usually takes a hit in the short term, but eventually it recovers and then it moves up from there. So I'm very excited about Rivian. And now I'm more excited about Rivian than I am about Robinhood, and therefore I exchanged some of my Robinhood shares essentially for Rivian.
So yeah, circling back to the dilution bit, because when you were saying, the company's either going to go bankrupt or they have to dilute, that sounds very negative. And I just want to be clear, dilution is not a negative thing. It is a part of any company that is not profitable. They need to have the ability to invest in themselves, and that creates this dilution effect. But even if you own a smaller percentage of the company, the idea is the value of the shares you own over time will actually be greater than what it is today if done well.
That's exactly right. So yeah, that's exactly right.
Yeah.
Yeah, no, I mean, basically every company like that's not profitable, take OpenAI, Anthropic, SpaceX, et cetera, they've all been raising throughout, and their entire life, essentially. And SpaceX's case,
Series A.
Yeah, I think I don't know, SpaceX might be on Series X, but yeah, exactly. They raise, and in every single raise, in SpaceX's case, it's over 20 years of 20. I think they were founded in 2002, if I'm not mistaken. So 24 years of not being a profitable company. Every raise has triggered some level of dilution, and the idea that that Rivian just raised $1.2 billion and that's a bad thing somehow. Is just baffling to me. It just makes the company that much stronger. So I'm quite excited about their future.
Yeah, I'm also very positive. To me, all the news was either great or predictable. All of the numbers that they announced I thought were great, and the dilution piece was predictable. It's funny because I think a week or two ago we talked about how Rivian's kind of been in this range for a couple of years now between the $10 and $20 mark. They haven't been able to really break out of that. And this is just another example of that. I don't think that's a bad thing. I think it just creates more opportunity to buy. My gut, which could be wrong because it's really hard to time these things, is I think we're towards the end of of it ranging now with the R2 out. But you never know. These things could last way longer than anyone expects. And then the last thought I have is I think part of the reason why it's dropping back down to around this $15 mark, in addition to dilution fears, is the raise that they're doing. I think it's closer to $15 a share, not $20 a share.
That's right.
So I think the market is kind of going back to that range because that was where they're raising.
Yeah, a couple of things about the raise. I think the price was based on yesterday's close, and it was at a 6% discount. The raise is actually preferred stocks, and the buyers get an option to buy additional, I think, 11 million shares in addition to the 75 million, and they have like something like 30 days to exercise it. So, the buyers are clearly, thinking that 15 whatever 65 that they paid for it is a bargain, so that, obviously nobody's investing 1.2 billion dollars without thinking they're going to make some amount of return. But but in Rivian's case, for the past 2 years, there's a lot of frustrated investors because the stock has been basically flat, and the stock has been flat because there's been three things that have gone against it. Their revenues have been relatively flat. Their deliveries have been down to flat year over year, and then they've had negative margins. All of those three things are about to change, right, with the R2. So deliveries, we already know, is going to be up 100% year over year in the second half of 2026, unless something goes dramatically wrong. This is what they have guided to, so this is not unexpected. Their margins are expected to be positive by the end of Q4 as they sort of like, again, bring volumes up on R2. And the revenue is about to sort of like skyrocket as well. So the combination of these three things makes it super exciting. Now, my preference for their future raises, by the way, is that they would raise at the money, or what is known in the industry as ATM. Rocket Lab has been pretty good about doing this. So when they, for example, Rocket Lab announces that, hey, we're going to raise $1 billion or whatever it is, they usually go down. They take a hit right there, but they don't have to sell at that hit. At that moment in time, they can wait until their stock price recovers and then sell slowly, a little bit at a time, over the course of the next 6 months or whatever amount of time frame that they want, which is what they have been doing. And Rivian should do that in going forward in the future, in my opinion. So they should, their next time they announce that they're going to do a raise, hopefully not anytime soon, but like, let's say within the next 6 months, they should just come out and say, hey, you know what? We're going to do 100 million shares at the market, ATM. We'll decide when to do it based on our needs going forward. And they'll take an immediate hit on the stock price, most likely, because that's just what happens. But again, they don't have to dilute right away based on that stock price. They don't have to give preferred shares. They can just do common, and then they can sell that over time into the market. And as they crush their sort of like numbers and estimates, then stock price should go up, and those would be opportunities to sort of like sell a little bit, and raise the additional funds that they'll need in the future. So, the ATM method, I think, is probably better for a company that is starting to grow revenues rapidly and crush their estimates, but which is what Rocket Lab has been doing. I kind of like that method better than issuing preferred stocks at a discount, giving additional warrants and options. It's just not ideal.
I think that's a great call out, and an important nuance that not everyone recognizes.
From the timeline on Rivian perspective, or just any company that I jump into it, one thing is that I always remind myself that the market is not necessarily rational at any given moment, and could stay irrational, in my view, in my personal opinion of what a company should be worth versus what the market thinks it's worth. Those things are oftentimes not aligned for years. In Tesla's case, for example, when I was invested in Tesla, for roughly 5 years, the market and I were not aligned in terms of what I thought the value of Tesla was versus what the market thought the value of Tesla was. So the market can be irrational for a long period of time. So I can't answer timeline perspective on what might be the timeline for Rivian, but the company seems to be firing. I was going to say firing on all cylinders. I actually made a note on my purchase of additional Rivian today, but but instead I changed it to Rivian seems to be fully charged now to try to make a cute little pun for Dustin over here. But
thank you. I love it.
but it's executing perfectly, right? Like it now has a mass market product that is being very well received by the market. It's starting to deliver them. It's delivering them the $60,000 version of it, so it should be able to eke out pretty decent margins out of it. And it's well positioned, and it has tons of pre-orders to be able to sort of like carry it well into 2027. And then between now and 2027, all these cars should be on the roads, and they should get additional new buyers excited, and like there should be sort of an influx of new buyers coming online. Exactly what happened for the Model 3 and the Model Y for Tesla. So, the coming years for Rivian feels like they're going to all be positive years, at least for the foreseeable 3 or 4 years from now. And then what happens beyond that is kind of hard to predict.
Hi, Hamid. On Rivian, don't you see a huge competition from Chinese car makers hurting future profits? Stellantis and other European makers are struggling, closing factories and reducing workforce. Another person also asked about if you're worried about the for Rivian about
Chinese,
because of the Volkswagen cost cutting too.
Okay, so I actually wrote a piece. It's been probably like 9 years ago that I believe that the vast majority of existing car companies are going to go out of business. These are companies that are making sort of engine-based vehicles because the future is EVs. And I speculated that time frame is probably somewhere in the 15-year time frame, so maybe another 6 years left. But I may have been overly predicting it to happen way more quickly than it would happen. But I suspect it's probably not more than 10 to 15 years away where we cross that 50% mark threshold of more than 50% of vehicles being EVs. And therefore, all the existing car makers that are still just making gas-powered cars are going to have to reduce their staff and lay off and shut down various different production lines pretty substantially, and possibly go bankrupt in some cases. That I still believe is going to happen. It's hard to say exactly when these things will happen, but it will happen as the transition to EVs accelerates and hits a certain threshold, probably 50% mark. The companies are going to we're going to start seeing some consolidation and or bankruptcies. So that's just sort of like answer the question of like, where's the EV versus, like it doesn't concern me that, Volkswagen is, struggling because, I expect all car companies that are not EV 100% are going to struggle. Now, within the EV space, every EV company has also struggled. So, but that doesn't mean the future is not EVs. So Lucid has been struggling and, continues to struggle and hasn't been able to sort of cross that chasm. Rivian has obviously been struggling, but like now I feel like it's about to cross that chasm where the growth sort of starts to accelerate and show its potential and become more obvious that it's going to hit future profitability at some point. And then the Chinese companies have been showing that this is going to happen. Basically, the entire China automaking industry is EV based. So they completely bet on EVs being the future, and they've done exceptionally well. Now, does it concern me that the Chinese might do a way better job than European and American companies? Yes, that is a concern. But also, US and Europe cannot afford to allow Chinese automakers to just dominate and kill their entire car industries, because that's roughly $1.5 trillion worth of products being sold every year by European and American car makers. So if you let that get destroyed, that's an incredible amount of economic and financial power and number of jobs that you're giving away to the Chinese companies. So I just don't see US and Europe being able to afford to do that. And therefore, they'll balance that by putting significant tariffs on Chinese imports or not allowing them to import. One of those two things are going to have to happen, and have been happening, by the way. And that's why you don't see any Chinese EV makers in the US. So that does not concern me as much. I do think that Chinese are formidable competitors in the space, and they've done a great job, and they have the cost advantage as well because labor is so much cheaper, and the EV industry has been backed by the government as well, so they've had excessive funds being invested into EV technology that we haven't had in the US and Europe hasn't had either. So yeah, those are some rough thoughts about the industry.
If you enjoyed this clip, consider subscribing to the Buy Hold Rant podcast on YouTube, Apple Podcasts, or Spotify. New episodes are released every Wednesday, and you can watch them live on YouTube.